Thank you very much, Victor. It is a pleasure to be here this morning to present Genex to you. We are absolutely passionate about this company and the potential it has to deliver wealth for all of our shareholders. What you see on the screen behind me is a picture of our flagship project in North Queensland. It's a globally unique project, and our business is all about the generation of clean and green renewable energy and the storage of that energy. So what you can see in the background there is our first operating asset. It's a 50 megawatt solar farm. In the foreground, you can see two enormous holes in the ground that are now partially filled with water. It's our intention to start construction this year on turning that into our pump storage hydro project. When I look at that picture, I think long-term contracts, because each of these projects is backed by long-term contracts, which will deliver very, very stable returns for our shareholders. All right, so we operate in North Queensland, and believe me, there's a few characters in outback Queensland. One of them featured on that video. But the business itself, whilst I guess we're a green generator, a clean green company, our absolute focus is on returns for shareholders. We're business people. That's been our motivation for day one. And what we're building up here is a steadily growing portfolio of income producing assets backed by long-term contracts. Our portfolio is now diversified. So we've got our major hub in North Queensland, which we're developing in stages, but we're now commencing the construction of a solar farm in New South Wales, which I guess is the first plank of our diversification and growth strategy as we spread our operations nationally. Our market capitalisation is around $100 million. The cash there says $18 million, but we've been profitable for the last quarter, so current cash is $25 million. But I think it's important to note that the board members of the company are all significant shareholders in the business. And for that reason, there's a very strong alignment of interest between the management of the company, the board of the company, and shareholders. So I think that's a very, very important takeaway. We are absolutely committed to delivering for our shareholders. We've recently raised some money, and that has introduced a number of significant institutional investors to the register, Australian institutional investors that are joining the story and can see the potential of the income stream that's now steadily growing. This slide is complex, but I'll talk you through it because it really shows you, I guess, the depth of these projects and the long-term contracts that underpin the company. So the first line here is our 50 megawatt operating solar farm. This asset was constructed in 2017, so it's been operating steadily since that time, and that project benefits from a 20-year income guarantee from the Queensland Government. So what that means is for the 20 years till July 2038, the Queensland Government guarantees $13 million of revenue every year to the company. And with renewable projects, you can imagine operating costs are very, very low. The sun is free. So we've got a very small labour component to maintain the assets. So we have gross margins here of 90%. And that is true for our first asset, and it's holding true for the other assets we're developing at the moment. So stage one, 50 megawatts, 20-year Queensland Government guaranteed income stream is what we think a very solid underpinning for the company. The real focus now is delivering our hydro pump storage project. I'll explain a little bit about pump storage and why it's relevant in a moment. But in terms of the incomes and the contracts that underpin it, we expect to commence construction before Christmas of this year. So within a few months, we'll have 500 workers on site building this project. It's a strategic asset. We think of it as a giant water battery. It's a way to store energy and dispatch energy at peak times, similar to what's being talked about in Snowy 2.0. The difference is we're several thousand kilometres to the north in Queensland. The key here for Genex is that we have reached a term sheet with one of the major Australian energy companies, Energy Australia, Melbourne-based but national in operations, have agreed with us via a term sheet to invest the equity in the project to get it up and running in return for half of the project in a joint venture. And in addition to that, they will guarantee the revenues for an extended period of time. So what that does for Genex, it hands the operation of this hydro pump storage asset to a Tier 1 energy company in the form of Energy Australia. Energy Australia will operate the asset. They've got the expertise to do so, and they will pay a rental arrangement back to Genex and themselves, 50-50, for the rights to utilise that asset. So what we've done here is created a very, very stable income stream for Genex, I guess as a reward for developing this project over the last 5 years. And I think it's worthy to note that Energy Australia is one of the more highly credit-rated counterparties in the Australian market. They're BBB+, which means that income stream is, we believe, very, very secure income stream. So in terms of the Queensland operations, we've got plans to expand the solar farm and also a wind farm. I won't talk about those for the moment because they're pipeline projects and not part of our short-term funding mix. But I will highlight the Gemelong slide, which is the Gemelong project, which is the last line on that slide. It's a 50 megawatt solar farm. It's located near Forbes, which is near Parkes in New South Wales. And that project will commence construction in the next 1 to 2 weeks. So we're very, very excited about that project because that project alone has the potential to double our revenues 12 months from now. So I guess if you look at the earnings makeup of Genex, you'd see a 20-year contract delivering $13 million of revenue today on a 90% gross margin. That revenue stream doubling 12 months from now, with the revenue coming from the Gemelong solar farm. So we're excited by that. We've raised the capital to commence the construction. We're just finalising the bank documents at the moment, and we're confident that will have a significant impact in terms of earnings momentum for the business commencing from this time next year. Timelines are absolutely critical, we believe, to running any company, but particularly a company that's listed on the ASX. And I think I want to highlight here the first line, the solar farm that's operating in Queensland has a 30-year economic life, 28 years to go, and that will obviously generate that stable income over that remaining period of its economic life. The hydro project will start construction before the end of this year. That project's got a 3-year construction window. It is a significant piece of infrastructure, but once in operation, pump storage projects or hydro projects more broadly have 80 to 100-year economic lives. So I think it's fair to say this asset will be still generating income in the year 2100. Well, after I'm gone, but certainly it does demonstrate the fact that it's a very key piece of infrastructure and I guess has the capable to generate very, very stable returns over its economic life. And dropping to the bottom of the slide, you'll see the Gemelong project with construction happening in the next month or so. That project has got a less than 12-month construction window, so we'll see that generating its cash flow to the business 12 months hence from today. And again, that project has got a 30-year economic life. So I guess what you see there is a diversified portfolio. It's a growing portfolio, each of those assets backed by long-term contracts, delivering those returns to shareholders. Just one slide on the revenues generated to date from our solar farm. Revenues from inception to the end of August were $21 million. We're generating a few $1 million a month, so that's obviously growing since that date. And we're very, very happy with the performance of that asset and the income it's generating to the business and I guess the energy it's putting into the Queensland grid. Clean energy credentials. We are, I guess, a green company. I said at the outset that that is not our focus. Our focus is, as business people, on shareholder returns, long-term contracts and income generation. But I'm very pleased to say that we're doing that in the context of being an ethical, sustainable investment opportunity. And you'd expect that from a renewable energy generator, and I guess we're no exception. So by the time our portfolio is up and running, the hydro in particular by 2023, the combined fleet of these assets will be equivalent to the abatement of 2 million tonnes of CO2 per annum. So that's a huge amount of CO2 abatement, 2 million tonnes. It's the equivalent amount of CO2 emitted by 240,000 households. So this company alone, through its projects, will have a significant contribution to CO2 abatement and I guess feeding into that whole climate change debate that our politicians often have. What is pump storage? The video's attempted to explain what it is, but really it's nothing more than a giant water battery. What it does, it has two enormous reservoirs filled with water, one higher than the other, one upper, one lower. And when energy prices are low, when energy is in surplus, energy is used to pump water through tunnels and turbines from the lower reservoir to the upper reservoir. That water is then stored in the upper reservoir so that it can be released through the tunnels and turbines to generate power at times of peak demand, which is also at times of peak price. So I guess the profitability of the machine benefits from the delta or arbitrage between peak and off-peak prices. This is a very mature technology. It's been around for more than 100 years, with the first one of these plants in operation in the 1890s. So there's nothing new in what we do. I guess the science behind what we do is find the right sites. We put in place the right contracts to be able to monetize this mature technology for the benefit of our shareholders. And of course, when we're using energy to pump the water from the bottom reservoir to the upper reservoir, we can use energy from the grid, which could be sourced from our next door solar farm or a wind farm or from any other source. Okay, so it's a technology agnostic, dispatchable, reliable generator of energy into the grid. Okay, so pump storage, look, there's over 1,000 of these operating around the world. You can see there's many of these operating in Europe and North America. There's now a resurgence of development of pump storage, and the reason for that is that there's now the growth of substantial amounts of new wind farms and solar farms. And we all know that wind farms only generate power when the wind's blowing, and likewise solar farms only generate power when the sun's shining. So those are intermittent generators. The generation can't be controlled or dispatched, so there needs to be a very low cost way to store power. And pump storage hydro, being a very large scale form of energy storage, is a low cost proven technology. It's for that reason that the federal government through Snowy is expanding one of its projects called Snowy 2.0. At the moment, there's only 3 operating pump storage projects in Australia. There's the Tumut 3, which is part of the Snowy network. There's an asset operated by Origin Energy near Sydney called Shoalhaven, and there's one near Brisbane called CS Energy, or Wivenhoe. So our project will be the 4th project to be developed in this country, the first one since the 1980s. But following us, there's probably half a dozen pump storage projects that will be developed over the next 4 to 5 years. People often ask me about a comparison between lithium batteries or chemical batteries and pump storage, and my response is they both store energy, but they both have different applications. So batteries tend to be for small household applications, whereas pump storage is clearly grid scale energy storage. But the key point of difference here is cost on a per megawatt hour of energy stored basis. So if you look at a battery, and this is using the examples of a battery that was built in South Australia and 2 in Victoria. And you can see that on a dollars per megawatt hour of energy stored, the cost of a lithium battery is around $750,000 per unit of energy stored. If you compare that against our project, for example, it's around $240,000 per megawatt hour of energy stored. The other difference is pump hydro lasts for 80 to 100 years, whereas lithium batteries need to be replaced every 10 to 15 years. So if you take into account upfront cost advantage, economic life, you can see why the weight of money has gone into pump storage, because it's a low-cost, proven technology. And I think this slide illustrates that quite nicely. Our project, our hydro project, is shovel-ready. We will be commencing construction before Christmas, and the reason why we can say that is that we have now assembled a Tier 1 group of partners to deliver this project. Each of those logos here you can see has a very detailed contract that underpins it, which I guess supports the delivery of their role in the project. So first and foremost, Energy Australia, I mentioned they're the very, very large, very capable energy generator, energy retailer. They'll be our partner in this project. They will own the project 50-50 with Genex. They will also operate the asset and trade the asset and pay rent back to the joint venture. We have been turning this year a term sheet into a binding contractual arrangement, and we believe that the final investment decision will be made by them and by us very not too far from now, certainly before the end of this calendar year. In terms of the debt funding of the project, you can see a logo there, NAIF. That is the Northern Australia Infrastructure Facility. That's a federal government body that has been set up to support infrastructure in the northern half of Australia. They have announced and signed off on a $600 million low-cost concessional loan for this project. So the equity from Energy Australia plus money we have raised together with the NAIF loan is all the funding required for this project. So it is a funded project, and a key piece of this is the low-cost concessional debt coming from the NAIF, the federal government. We recently announced a transaction with J-Power. J-Power, I guess the J stands for Japan. J-Power is the largest energy utility in Japan. They operate coal-fired generators, wind, hydro and pump storage in Japan and globally. We chose them as a partner because of their technical expertise in running pump storage, not just in Asia but in other parts of the world. And the deal we've done with J-Power is they will contribute $25 million of equity, which is the equity we need for our share of the project, plus they will provide expertise to our management team in Brisbane to support the delivery of the project. So they'll provide the money and some of the brains required to make sure this project gets delivered on time and on budget. In terms of construction, we've got a fixed priced contract agreed with some major Australian contractors. Many of you will know John Holland. They're a tier 1 contractor. Them in partnership with McConnell Dow will build this project for us. Powerlink will build a new transmission line. The Queensland Government have announced the funding of that transmission line to our project. So literally all the pieces we need for the delivery of this project have been put in place, and it's a matter now of waiting for the final investment decision and the finalisation of the paperwork for us to enable the construction to commence before the end of this calendar year. One of the reasons which I guess motivated us to develop this project over the last 4 or 5 years was some of the changes we're seeing in the energy market. And what we are seeing are 2 key factors which are making energy storage more vital. Firstly, of course, I mentioned the growth of wind farms and solar farms. They're popping up everywhere. That's fine so long as the sun's shining and the wind's blowing. Of course, that doesn't happen all the time. And what we're seeing when the wind's not blowing or the sun's not shining is dramatic peaks in energy prices. So energy prices can go in the wholesale market from as high as $14,000 per megawatt hour to as low as minus $1,000 per megawatt hour. So that means if prices are negative and you're generating, you have to pay for the right to generate. It sounds very strange, but they are the rules. So what we've seen recently, particularly in South Australia and Queensland, but also down here in Victoria, are times when energy prices go negative for sustained periods of time. And that chart in front of you shows that during a 24-hour period, averaged over the first week of September, we had prices in the morning and evening peak around $100 to $200, which is obviously times when you want to generate if you're a hydro project. But during the middle of the day, when the solar farms elsewhere in Queensland are pumping because of the abundant sunshine, energy prices went negative. So as a pump hydro project, that is music to our ears because we would get paid to generate and paid to pump. I guess it's a bit like double dipping. Very, very profitable way or state of the market. So we are expecting the growth of more wind and more solar in the market to exacerbate this trend and will fundamentally drive the profitability of this project for the owners, being ourselves and Energy Australia. So in terms of outlook, I guess what we see today is one operating asset with a 20-year contract with the Queensland Government generating circa $13 million of revenue on very, very attractive gross margins. We have the prospect of that revenue stream doubling 12 months from now with the delivery of the Geelong project. It's a 50 megawatt solar farm in New South Wales. It will in itself deliver a significant amount of earnings growth for this business. However, the real upside will come from the hydro project with construction slated to commence by the end of this year. that project will deliver a substantial step up in revenues from first generation in 2023. So I guess what we see is 3 projects generating revenue under long-term contracts with the potential to pay a substantial portion of that income stream to shareholders in the form of dividends from the early 2020s. Thank you very much.
Thank you, Simon. Now, do we have some questions, please? 2 at the front here.
Would the project be viable without the cheap funding?
Look, I guess there's no doubt that the concessional funding does have a very positive impact on the economics. We've not disclosed the minutiae of the financial model to the market, but it's a critical element to the funding mix.
Okay, because governments can change things very quickly, you know. Imagine if they
Look, governments do change their mind, but once you've got a binding contract, which we have through, I guess, the NAIF loan facility, that loan will be drawn down, it will be expended under a loan agreement. So we wouldn't see any risk with that once it's been finalised.
For the pumping project, is the pricing locked in that if more renewables come on stream and that price difference widens, will you be able to capture that profit, if you like?
It's a very good question. So the way we've structured this arrangement with Energy Australia is they will be the market trader and operator. They will derive all of the revenues from the operation of the hydro project, and they will pay a fixed rent back to the project owners. So Genex's income stream won't be impacted by price volatility, energy prices, any of those factors. It will be receiving a fixed and known rental stream over the life of that contract. So I guess what we're trading is upside for certainty.
Do we have another question? Over there and then over there.
Hi, Simon. Over here.
Okay.
Just on that interest rate, just more broadly, can you just comment on the advantage of lower interest rates, how you can take advantage of that, and just sort of the capital structures that you're employing? Like, obviously it's a project type financing. Can you just maybe just touch on what sort of capital structure looks like and how that low interest rates really enhances the returns?
Sure, Mark. So the equity contribution is $100 million for the project or thereabouts. Genex's contribution is under $20 million, which is fully funded by the J-Power contribution. The balance of the funding mix is the debt coming from the NAIF. And the way the NAIF structure their loans is they seek to recover the government's long-term bond rate plus a small administration margin. So their business model is not to gouge developers of infrastructure, it's to stimulate the investment of infrastructure into Northern Australia. So they work with borrowers such as us to, I guess, to agree a repayment profile which fits the cash flows of the business. So it's a long-term loan which runs out to the late 2040s. So it's a very, very long-term concessional low-cost loan.
And just finally, just to comment on the excess return you make on your cost of capital over 20 years of IRR, or however you'd assess that.
On the new money that we're contributing to the project, the IRR is around 20%.
2 questions. One, I've always been curious about the overall efficiency of pumped hydro, the kilowatts of power that you get from sun and solar compared with the kilowatts of power you get out of the system. And secondly, how far away is pumped hydro from providing base load power?
So in terms of the efficiency of pump hydro, by virtue of pushing water uphill against gravity, you consume more power to pump water uphill than you get from generation when it runs downhill. I guess the profitability, and there's about a 20% loss by pushing water uphill or round trip efficiency. That's right. So therefore, the profitability is derived in the delta between peak and off-peak prices, which typically off-peak prices will be $40, $50 a megawatt hour. Peak price is $150, $200 a megawatt hour. So that's how the core profitability is derived in the difference between peak and off-peak. In terms of base load, I guess hydro is dispatchable energy, so it can be turned on at times of demand, and you would typically target the high price events, not the low price events. So coal-fired power stations burn 24/7. Hydros and pump storages tend to do a few hours in the morning and a few hours in the evening as shoulder generators.